What makes performance measurement for alternative investments different? Alternative investments have unique characteristics and are managed differently as compared to traditional investments. But what makes an investment alternative? There is no formal definition, but most consider hedge funds, commodity and managed futures, private equity, and real estate to be alternative. It also includes credit derivatives, corporate governance, infrastructure, and exotic assets such as artwork, automobile collections, wine cellars, water rights, film production, and carbon credits. Lately, the term has broadened to include almost any asset that is not publicly traded equity or debt. Let's look at private investments in more detail. Private alternatives tend to be illiquid because transactions are often all or nothing unless additional partners can be found. Even so, these types of investments tend to be chunky, meaning they are just not easily divisible. There is no division into minuscule share pieces by the millions that would be traded on an exchange as with, say, shares of Starbucks or Google. This has a huge impact on things like valuation, benchmarking, risk, and minimum asset size. Another key characteristic is concentration. Unlike the stock and bond markets, there aren't actively traded investments or opportunities that one can purchase on short notice. For example, one cannot go out on a given day and purchase as many strip malls as one likes. Because portfolios are less diversified, risk is sometimes defined as permanent loss of capital and is mitigated through significant due diligence. More often than not, a manager must carefully select among a very finite set of investment choices. These strategies are constrained by the business cycle, geography, and sector. This means that they are almost never scalable and cannot be replicated in a way that allows for organic growth by simply soliciting more and more investors. Another factor is leverage, and the dilemma as to whether to present returns on a leveraged or unleveraged basis. In some cases, leverage can result in zero or negative net asset values, and this can convolute the return calculation even further. This leads to confusion about what value should be used as the denominator in the return calculation. For example, what is the return on an investment when the net asset value is zero? Lastly, each asset is unique. Once you have the asset, nobody else has that particular asset. Each apartment, startup business, toll road, or movie script you acquire is one of a kind. This makes it hard to find benchmarks that will resemble your strategy on a passive basis. In fact, there really are no passive alternative benchmarks, just universes of your competitors' active strategies which may not look like your strategy at all. All of this gives rise to performance measurement practices that are very different from that of traditional stocks and bonds. Lack of liquidity means fewer valuation points. Fewer valuation points means fewer entry and exit opportunities, which means that cash flows are sporadic. The timing of such flows is intended to coincide with business or economic cycles. Consequently, the effects of capital contributions and withdrawals are a critical part of the return as calculated using time value of money concepts. This means that not only is internal rate of return the measure of choice, it is usually the only return measure that makes sense. These and other issues are addressed in Performance Measurement for Alternative Investments, which you can find online at riskbooks.com. Or for more information, visit Cane Island Alternative Advisors at www.caneisland.com.